I
And
used a digital
that was,
contracts thing this week, Steve. I used the one you're about to talk about.
we both used a digital contract this week. So the company we're going to talk about is Docusign, and we have touched on this one, but only usually pretty quickly. And this one should be pretty quick as well, to be honest with you. Revenue for them came in at $776.3 million. They were expected to do about 761 million, so that was quite a nice beat. That's about a 9% jump in revenue year over year. If you want adjusted EPS, Steve, that was 86 cents. Estimated was 84 cents. If you want it unadjusted, it's 39 cents, up from 13 cents year over year. Subscription revenue came in at $757.8 million. And estimated was 743.3 million, so decent. And again, they beat on billings as well, just to complete the hat trick. Maybe the quadruple. Billings was 923.2 million, and estimated was 920 million, and that's up 11% year over year. In terms of guide, they said they expected first quarter revenue to be between sort of 745 million, 749 million. And projected that full year revenue would be between 3.129 billion and 3.141 billion on the year. So it's a much bigger company than I thought it was, Steve. And even when you kind of use it, I mean, it's very good, but it doesn't feel that good. But anyway, when I checked when I was writing to Steve, which was about 3:00, it could be completely different now. It was up about 18% on the day, and it was about 2% down year to date still. So, but up 50% from its 12-month lows. So, doing pretty well. Docusign. Alan now he has one of those names which I was pretty convinced, like you, Steve, that it was Tristel. Was Thigerson, but I have since been told it's actually Tigerson. Is his name? The H in it is silent. He is from Google. He was vice president of Americas. He's come over to run DocuSign and as the CEO, and he said the company is seeing rapid traction with customers for its artificial intelligence powered intelligent agreement management platform that it launched last year. It announced this product in about April time, said it would help customers save time and money by creating, organizing, and analyzing contracts more efficiently using a form of artificial intelligence. About 17.7 billion in market cap, somewhere around that, Steve, trading at about 21.5 times forward earnings. Like I said, we've got some experience using this now. I think it's very good for quickening up the process of signing and returning contracts. So for the person who asked, my mum and dad have finally moved house. Their house was sold, and the solicitors are not using DocuSign, so they're having to make regular trips into the nearest town to drop these contracts off through the letterbox, because obviously they're quite important contracts. You wouldn't want to put them in the post with the way the Royal Mail is at the moment. But yeah, much quicker with DocuSign, and examples of things that still haven't quite moved over to them yet. Steve, how does this one feel for you?
Feels a bit like what you said when you said it's good. 16 or so billion or whatever it was of good. That feels like quite a big number for this. But that being said, it kind of makes more money than I realised it does. That's a price to sales of about 5 and a bit, and 5.6 or so. That's not crazy. And actually, those sales have been growing pretty nicely. You were saying it's grown 9%, which is decent. And at 27 times earnings, you're looking at something reasonably sensible there, I think. And if you use the adjusted earnings, because who doesn't want their earnings adjusted, right? It looks even kind of better value as well here. Nice factor about this is that pretty much all their revenue is subscription revenue. Then 770 million total, 757.8, which is basically all of it, but lost some of it down the couch in subscription revenues, which is a nice thing you want to see. That's the kind of big attraction for these kinds of businesses. They tend to be sort of fairly durable, fairly stable. things. It's not so long ago with Docusign. I mean, it probably is actually. It's probably a couple of years actually, but in the grand scheme of things, not so long ago that I think people were kind of overexcited about this thing of thinking, oh, but it's going to do all kinds of things, and yeah, maybe. It does a few things. It does things very, very well. It's becoming, I think, the kind of industry standard. I'm not sure. I have used a different document signing service, not Adobe, but I couldn't tell you the name of another kind of smaller independent document signing thing that I can think of these days. It's pretty much Docusign or not really interested in these cases, and that's a nice kind of. It feels to me like it has a big position in a niche, which is a thing that I quite like, and it's a niche that's clearly growing because I mean I say niche, it's not like an industry specific niche. People have documents all over the place and they need signing all over the place, but it's quite a specialist thing. It feels to me like it would be a nice thing to have as part of a bigger company, but I'm not sure I see the this is an obvious takeover candidate given the current size and price of it. It doesn't look to me like it's well down. Maybe kind of it's up 15 or so percent ago today, and maybe at that level, I thought it might have been. You might have been able to get in there with a sort of 20-ish% premium, and it would be kind of high and so on, but not terrible. Stock-based comp is always the thing we look at on this, and I see that their share count appears to have grown by about 50% over the last 10 years, which if you wander down a kind of tick box and don't look for that to happen quite a bit will put you off. The way we think about these things is that, yes, it has grown 50% over the last 10 years, and that is a genuine negative against it, in that it would be nicer if it hadn't done that. The trouble is the revenues have also grown by, in the same period, about 10 times. So, you'd give away 50% in stock-based comp to have 10 times the sales for pretty much any business that I can think of. If someone said, okay, print another 50% of your sales of your market cap in shares and you can 10x your revenues, I can't think of a company that's not taking that one way or another. I think the reason most companies are not doing this is because they don't have the chance to, and that's fair enough as well. You shouldn't do it if you are in a market where you can't do that kind of thing. But um, yeah, very impressive from Docusign, and free cash flow is starting to come through here a bit. Yes, there's a rising market cap, but rising share count, but its free cash flow is starting per share is starting to come up and up and up here, and it's getting to the point where if so much stuff wasn't on sale, I could see my way to being interested in this again. Actually, Steve.
Yeah, I could agree with that, Steve. I think I mean this IPO'd roughly about 10 years ago, and it was about 6 billion when it IPO'd. So even if you factor in that 50% additional share count, when say the IPO was 9 billion, it's still doubled since then with some pretty decent falls in the middle. So a stock that's done very pretty well. Last year there was actually an attempt to acquire it. I don't know if you remember, Steve. It was sort of January or February. Bain Capital and Hellman and Friedman were trying to buy it for about 12.5 billion. DocuSign declined at that point and said it was more interested in being a public entity, and has remained so and done pretty well, Steve. So, like you, I think the share count is the rising share count is an issue, maybe an amber flag, but the revenue growth is like a huge green flag that kind of overrules your amber flag in this occasion. And also these kind of companies, Steve, the share price increases, they reach an inflection point, and then they start becoming cannibals of their own shares because they generate so much cash. There's just nothing to do with it. It doesn't feel like a natural dividendy kind of paying stock at all. I think what they'll start doing is cannibalizing stock, and I would expect that to start happening. When the revenue starts to slow and the EPS starts to slow, that's one of the ways that you can boost those per share numbers up, is by taking the share count down. And I would expect that to see that happen, in the not too distant future. But like you, Steve, it's quite firmly on my watch list of stocks. I do really like DocuSign. I just also think a lot of people do at 17.7 billion, evidently, and I'm just not sure it's worth that much. But I mean, like you said, Steve, it makes a lot of money. makes more
Yeah.
money than you expect it to.
Yeah, I take the view it doesn't really look like a sort of natural dividend stock either. It also doesn't look to me like a kind of natural, constant innovating growth stock thing either. I mean, I feel like it's got the hold of its niche, and I feel there's only so far to improve this product from here, and I kind of see that as a very good thing. It is currently very, very good for signing documents. I'm not sure how you innovate that much further and make it an awful lot easier. It's not like, say, it's not like an iPhone, right, where you're constantly adding new features to this thing. I mean, I'm not entirely sure, having successfully digitized signing stuff, I'm not sure how much more I want anything digitized and move forward here. And that's probably good from a kind of R&D perspective. You get people into your system, keep them on a subscription, provide a product that works, don't screw it up. But after that, reinvestment opportunities are fairly low, so cash goes back to shareholders. Fine, you can keep inching prices higher and so on. So get this at the right price, and there's still plenty to go in terms of signing up more customers. But once you get there, this doesn't look like a terrifically capital intensive business, even at the level of kind of R&D and wanting to stay ahead with your next innovative techie thing, Steve.
It sort of makes me think, Steve, if it's not gonna do anything else, I wonder if it would be would be better being part of like something that already does other things that could use it. And that point straight away, the company that comes to mind for me would be Intuit. I think Intuit buying something like Docusign would quite nicely complement the things that they do. And also add obviously what is quite an important kind of professional service to their fleet of services. So yeah, I wonder. I mean, I wonder if Intuit are just using DocuSign and paying for it, and I wonder if at some point they look at that and say, "Wouldn't this be better if we weren't paying for it like that, and it was already part of us?"
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.